I have been asked by some colleagues to talk about the capital adequacy requirements for Islamic banks. But before going to the discussion about the capital requirement for Islamic banks, I would say that we have to understand why there is a need for capital adequacy requirement. One of the more important part that we have to look at is the moral hazard issue of shareholders, which is basically the bank shareholders has very little capital in the overall capital structure of banks that give them incentive to take more risky bets to increase the return for the shareholders. To cope with this issue, back in 1998, the Basel Committee has introduced capital regulation where banks were required to maintain a specific level of capital, especially during the time when there is a shortfall in economic activity or there is a run on banks. So this capital standard kept improving. We have got the risk-weighted assets. Now this capital standard requires banks to maintain buffer against the credit risk, market risk and operations risk. Well, Islamic banks face very similar risk as that of the conventional banks. So the IFSB has introduced capital regulation for Islamic banks to be maintained, and they're required to maintain similar level of capital as that of the conventional banks. However, the calculation methodology is a little bit different, mainly due to the nature of the transaction that Islamic banks are dealing with. Islamic banks are required to again manage the same three component of capital against three different risks: the credit risk, the market risk and the operational risk. However, the major difference between a conventional bank and Islamic bank is the existence of investment account holders in the capital structure of Islamic banks. Islamic banks receive deposits as an investment, and then Islamic banks invest those investments, and whatever be the profit is distributed among the account holder and the bank. The nature of the contract between investment account holder and the management is a mudaraba contract, wherein banks professionally manage the funds, and if there is any profit, it will be distributed between the depositors and the bank. In case of losses, all the losses are transferred to the investment account holders. Now, in Basel capital adequacy requirement, there is no provision for investment account holders, while in case of Islamic banks, major chunk of their deposits are from the investment accounts. However, there are two ways to look at these accounts. One is the restricted profit sharing investment accounts, where the depositor basically instruct the bank to invest that money to a specific project or to specific projects. While in case of unrestricted PSIA, the account holder basically has given the full freedom to the Islamic bank. Wherever they want to deposit the money, wherever they want to invest the money, they can invest that money. So regulator, when they look at the unrestricted PSIAs, they seems to be more comfortable to consider it as a deposit in conventional bank. Hence require Islamic banks to maintain capital against the assets that are financed by using the funds from the unrestricted profit sharing investment accounts. IFSB has given a special discretion to the regulator, where the regulator can determine what proportion of funds of unrestricted PSIAs can be treated as equity. And for that, the regulation allows Islamic banks to treat that portion of investment account holder as equity, and any assets financed by that specific proportion of investment account holders fund will be used, can be used to create to release some more capital for Islamic banks to fund more activities. Very interesting part of that proportion is there are three risks, as I mentioned earlier, that a bank has to pay a price for that. One is the credit risk, the other is the market risk, and the final is operational risk. While maintaining the restricted PSIAs, a clear record, and profit and loss from the investment of those assets, the Islamic banks can pass on the losses of credit risk and the market risk to the investment account holders fund. However, they cannot pass on the operational risk component to the investment account holder for a simple reason: the investment account holders are paying to the Islamic bank the market and credit risk that they are taking, but not for the operations. It's similar to like negligence of the Islamic bank or failure of their systems or something like that. So this is an important deviation from the standard Basel III contract. Furthermore, the other element that we have to look at when we are talking about the Islamic finance, the investment account holder, or the capital regulation requirement for Islamic banks, we also have to look at the pool management of the restricted PSIAs. And this is a really important part, because this will determine what are the how the funds are managed, how the funds are invested, whether the fund has generated any profit, or in case of losses, how the losses are treated. IFSB regulation allows banks to maintain two reserves based on from the pool. One is the profit equalization reserve, and the other one is investment risk reserve. Both of these reserves are very important for the well functioning of the pool of for understated PSIAs. The profit equalization reserve basically is considered as an operational need, where the depositor may require a return similar to the return of conventional banks. So they are willing to. So the bank has to keep some profit away from the depositors, just in case if there is a higher demand for a return in a specific period of time, so that can be used to pay off the depositors. Well, investment risk reserve is basically the reserve for the loss. It's a kind of provisioning for losses from the investment account holders. So both reserves are important, especially I would say that the profit equalization reserve is more important to make Islamic banks more competitive in the market. However, this also leads us to another problem, which is the displaced commercial risk. So maybe these are a few things that needs to be taken care of when we get into the any revision of the capital requirement.